Hey everyone. Well, we've had an interesting couple of days here in September 23rd and 24th. A couple of pretty important things have happened out of the markets and some things to pay attention to. Right off the bat on September 23rd, we had, what can only be described as Chairman Powell speaking at an event, at an economic forum, and his words, as usual, move markets. He said something in particular here at the end of the clip that we'll see, that is the idea of what the Fed thinks about equity prices. But right before that, I always like to point out this notion of forward guidance that the Fed has. And that's their main tool that they're using. And it's interesting now that Powell has been speaking more and more about this because previous Fed chairs weren't so forthcoming. So let's take a quick look.
Correct.
That's right.
And how, let's talk about how the average consumer is going to see any difference in the intervening months relative to an easing of interest rates and the ability and maybe even more confidence to spend.
This is always the interesting thing about cutting interest rates. The whole idea is that it's supposed to release money within the economy, increase liquidity flows, because with lower interest rates, the idea is that it's not as profitable to save your money. And so if it's not as profitable to save your money, and also interest rates on different interest rate sensitive assets, such as houses, car loans, just loans in general, is easier to get, because you have to pay less money back for that loan. The idea is that consumers will spend more. They'll spend more of their savings, and they'll borrow more in order to participate. And so the question here, which was asked at the Fed presser last week, is, what's 25 basis points really going to do? Like, what does the cutting of the rates, what do you expect it to do for the regular consumer?
So we don't set mortgage rates, but when we change the federal funds rate, it will affect the mortgage rates, and also all other consumer borrowing rates. Really, all interest rates that are on a floating basis will move a little bit or even a lot if they're short term, based on our moves. So the people will feel that over time. Also, it's not just these days. The market is pricing in the next 6 months what's going to happen to rates. So this is something that wasn't really the case 50 years ago. Now markets listen to us and follow, and they make an estimation of where they think rates are going, and so they'll price things in. And so longer term rates will move because of what the market expects, market participants expect us to do. So you'll begin to see, and you're already seeing changes in rates long before we make the decision. It can often be already priced in.
You hear that? Long before we make the decision, it can already be priced in. So I hope this helps clear up the misconception here that the Fed is the one who sets the rates. Really, it's the market that sets in the rates. When he's saying that the market is pricing it in, they're speaking, they're forward guiding, they're saying different things in order to cause the yield curves to move in the way that they expect. So I thought it was pretty interesting. But let's jump to the thing that actually some people are credited for the market actually falling, the equity markets falling precipitously on September 23rd, which was this comment right here.
Is it fair to say that the Fed and the markets really have a higher tolerance for risk today, more so than perhaps before the pandemic?
I think if you look at some prices, then they're elevated relative to historical levels. There were times before the pandemic when it happens periodically. Equity prices will move up and down, and we do monitor that. But we're not targeting any level of prices for particular financial assets. We don't have a view that we know what the right price of any particular financial asset is. We do look at overall financial conditions, and we ask ourselves whether our policies are affecting financial conditions in a way that is what we're trying to achieve. But you're right. It by many measures, for example, equity prices are fairly highly valued.
Let's segue to the top.
Equity market prices are fairly highly valued. So when we took a look at markets on the 23rd, we saw a pretty big drop here. This is from September 23rd, and basically to where we are now, actually to the low, we had a 1.53% drop, which is pretty significant when it comes to the equity market. And some people are attributing that conversation to the market drop. The idea here is that, oh, the Fed doesn't want the markets to be this high necessarily, and so it might not be sanctioned. Of course, I think that is personally silly. I think we're headed into option expiry at the end of the month for September 30th, and we have volatility is not as well supplied as it is other parts of the year, and so you could totally expect prices to fall or equities to fall as soon as there's any sort of turmoil whatsoever. We even had the VIX that ticked up a little bit in order to show that we had market down, vol up. I'm not an expert for that. You want to go speak to. If you want to learn more about that, please go to Ken Carson. His series of videos, his interviews where he talks a lot about this idea of the options expiry is definitely a must listen, must watch. Some of the other things that has happened on the 23rd has been we have here now moving to the 24th. The interesting thing that's been going around quite a bit is two things. One, the FINRA has approved the amendment to dismantle the $25,000 pattern day trading rule. So people won't need to have $25,000 minimum in their account in order to trade. And that way they could have, I believe it's $2,000. It's been approved by FINRA. It needs to be, I believe, ratified by the SEC, but it looks to be all but done for. So if that's the case, we're going to see a lot more entrants within the retail trading space, a boom. So I would not underestimate what that can do for markets. Right? If you take a look at the billions of dollars that's there for zero DTE in the option space for futures trading, and how all these derivatives can actually move the markets. Right, as you have more participants in there, it can move the markets in the same way that we saw for GME. That can be pretty interesting as well. All right. The other thing has been the divergence between gold and Bitcoin. So the divergence between gold and Bitcoin has been pretty spectacular, with gold rising pretty significantly and Bitcoin middling here. We have Bitcoin that is essentially flat here when we consider since July, with a potential propensity to move lower. That's what the price action seems to suggest, especially since there were a lot of predictions, mine included, for $250,000 by the end of the year. Could we still get there for Bitcoin? Sure, of course we can. But no point in being Pollyanna about it when we had this momentum that has faded a bit, even with the short squeezes that we've been seeing. I could totally expect Bitcoin to fall towards the $92,000 level before it finds any sort of support in order to bounce. Of course, there's the whole issue of what's going on with the liquidity markets, how the debt refinancing is going to be changing some of the liquidity characteristics that we have over the next couple of years, and how the higher interest rate on bonds, on debt, is different, very different than the previous cycles for Bitcoin. So, this time might be is different. We hear that all the time, and some people see that as a cautionary tale that, hey, this time it's not different, but it's hard to argue with the facts. Interest rates are significantly higher, and that's going to have some major consequences to liquidity. So maybe that stems the momentum to the upside, and maybe that stems the momentum to the downside. Oh, maybe we don't go as low as we did last cycle. Maybe we don't drop 80%, and we drop only 50% before we bounce back up to new all-time highs. You think people are prepared for that? I think not. Okay. Well, that's it for today's daily briefing. We'll be back tomorrow. with more news. I believe we're going to be talking about Luke Groman's interview that he did a couple of days ago, where he talks about some of the liquidity dynamics that he's paying attention to. Always nice to get a bird's eye view from what other people in the FitTwit space are saying, and we'll be sure to bring that to you on more daily briefings. But until then, we'll see you next time.